Good evening, everybody. Welcome. This is very excited. I'm very, very excited to be here with you and sharing some interesting thoughts and ideas about a topic that is very dear to me and to the majority of our clients. Tonight, you're being exposed to a Truth Be Told webinar, which is paramount for us because this is where we actually get to address and illustrate all the fallacies and all the challenges that most of us are going to have in retirement at some point in time in the future. Tonight's webinar is how to maximize your retirement benefits in the 21st century, which is very, very critical to all of us. Not too long ago, I was just growing up and playing baseball in college and doing all kinds of stuff. And then I started to get into the workforce, and now fast forward, I'm just getting ready for retirement. Although in my situation, I don't think I'm ever going to retire because I love what I do. I love to be able to communicate with people. I love to be able to educate clients, friends, and many of you in also helping you mitigate all the challenges of retirement planning. I'm excited because we do have, I'm looking at my screen, we do have quite a few people joining us. I'm sure a few others are going to join in a few minutes. We have people from California. We have people from Boston, Massachusetts, my city. That's, to me, the greatest city in the world. We have friends and clients here from Miami, from Fort Lauderdale, from Tampa, from Jacksonville. We have people from Dallas, Texas. So we have a combination of personal clients that enjoy these webinars, educational workshops that we do on a regular basis. We also have friends and co-workers have decided to join our webinar tonight. And we also have a bunch of newcomers that don't know much about myself and the firm, but they're very much interested in the topic at hand. So without any further ado and without any more wording, let's get into the webinar. So I'm going to go ahead and make my screen available to all of you so you can take a look at it. And we're going to be ready to share a lot of good information with all of you. I do ask that for all of you on the call, this is very critical information, so I would appreciate if you can go ahead and turn off your cell phones. Try not to get any distractions. If you do have some kind of a pad, that'd be awesome because we're about to share a tremendous amount of information that is going to be very critical to all of you, and we want to make certain that you don't miss anything along the way. So I hope you're all ready. I'm ready. I'm excited. I get excited when I do this on a regular basis. So this is very interesting. In addition to doing these PowerPoint presentations, we also use calculators, financial calculators. We use LEAP economic models that we are experts in. There are not that many of us that have the ability to use economic models with our clients. So we're just going to provide a lot of information. Our number one goal is education to all of you on the call tonight. Now, for those of you that don't know much about me, I'm Bert Salazar. I'm the managing member and managing partner and founder of Cambridge Financial Partners, LLC, and also Camelot International Group, and I'll tell you a little bit about those two organizations in a couple of minutes. I'm a U.S. Marine, first and foremost, although I was in the Marine Corps many years ago. Back in the 70s, I was in the 1st Marine Division out of Camp Pendleton, California. I'm very proud of my career in the military. And as they say, once a Marine, always a Marine. So wherever I go, I'm always introducing myself whenever I need to speak about my military life, about being a Marine first and foremost. Obviously, family member is also very paramount. I have a beautiful family that I'll tell you about in a minute as well. I attended Boston State College, my favorite city in the world, as I said earlier, and Nova Southeastern University here in South Florida many years ago. I have an accounting degree. I have an economics and financial management background. And what that has done, that has given me the ability to be able to understand financial issues and concerns from a different perspective altogether. I was also a City of Miami law enforcement officer, and I was also a law enforcement officer in the state of Massachusetts, again, many years ago. What that did, it gave me a tremendous amount of experience in the area of pensions. So I deal with a lot of public employees in the pension sector, both at the federal level and the state level. So for instance, I deal with FBI, DEA, Customs, Secret Service agents, NCIS, which is the Naval Criminal Investigation section of the Naval Forces. So I'm able to really assist them in providing financial education and planning along those lines. I'm a former registered principal. I was in the securities business for many years as well. I have had all the licenses that you can imagine, the 6, the 7, the 65, the 66, Series 24, Series 26, which are the supervisory licenses. I supervised a major organization, a public organization in Southern California with over 140 employees for a number of years as well. I am the founding member, as I stated to you, of Cambridge Financial Partners and Camelot. Cambridge Financial Partners is the insurance and the pension and the planning side of the house. So we do a lot of the insurance planning for our clients, a lot of the pensions. We do the tax planning along those lines as part of Cambridge. And also we do all the planning in reference to economic models and financial planning and so forth. The Camelot side of the house is the investment side of the house. And we specialize in alternative investments. We specialize in investments that have a high degree of success in the marketplace, and including life settlements, bridge loans, property acquisition programs, and certain investments that many of our competitors don't have the ability to do. And we are very proud of our ability to be able to get our clients from point A to point B by using alternative investments as opposed to the traditional investments in the marketplace. And there's a big reason for that. Risk has a lot to do with it. And we deal with clients that are either getting closer to retirement or they're in retirement already. So for them, risk management is a critical issue of everything that they do in their lives. I am also a certified financial education instructor, which is a CFEI, through the National Association of Financial Educators. So I am also very proud of the fact that I get hired on a regular basis by companies to come in and educate their employees in all areas of financial planning and service and tax planning and so forth. Last but not least, and this is the one area that I'm extremely proud, the most proud that I can ever be, is I've been married to my sweetheart for the past 33 years. She still likes me, so I think I've done something good along those lines. And we have two beautiful daughters. One is 28 years of age and the other one is 25. So enough about me. Again, I wanted to do this for those of you that don't know who I am. My friends and my clients, obviously on the call, know this better than anyone else. But let's get ready to go into this phenomenal workshop and informational piece that we're about to share with you. The webinar topics that we're going to cover tonight, obviously retirement issues and concerns in the 21st century, which is something that has never been known by any other generation in time. We're going to talk about what are the critical eroding factors, you know, all the different things that are going to be thrown at you, and they're going to be eroding your wealth and your retirement income, and how to deal with that in the future. We're going to be discussing taxes and retirement, which goes hand in hand, and it's a major, major issue that the majority of my clients are dealing with today. Retirement distribution challenges. We're going to get you to understand how to make that paradigm shift, because most of us on this call have been accumulating assets for many, many years. Yet now all of a sudden you get to retirement and you have this stuff all over the place, and you have no idea how to distribute those assets. You have no idea what kind of a portfolio you're going to build, and we're going to help you along those lines in tonight's call. We're going to share a couple of income strategies for you to be able to maximize your income. And we're going to talk about long-term care planning, which is a major, major issue moving forward, especially because of longevity planning in the United States. And then last but not least, we're going to share some case studies that I think are going to bring about a lot of good information that all of you are going to want to know more and more as the time goes on. Let's get into retirement issues and concerns. When it comes to retirement issues and concerns, there are a number of factors that are going to be impacting your lives and the lives of all of us in this call and the majority of Americans in the marketplace. Obviously, at the very top, longevity plays a major role. People are living a lot longer today than they ever did before. You know, what used to kill us 30, 40 years ago is no longer doing that. So therefore, longevity has created a major, major problem for retirees because you have to be able to plan for sometimes 3 decades in advance if you want to mitigate all of those financial potentials. The second area is the area of savings. The American society is a spending society, so the majority of us are used to spending money. The majority of us have not done really a good job in savings. You know, most Americans have not been able to save 20 cents out of every dollar they make. Now, we may save a little bit later on in life as we're getting closer and closer to retirement, and we may even increase our savings rate. But when you factor that savings rate over a 20, 30, 35, 40-year period, we as Americans have not done a very good job at savings. By the same token, we have to deal with all the erosion and all the different risks that are attacking at everything that we do, and we're going to talk about those in a minute. But those are the ones that we have to be very careful and we have to be able to deal with, because otherwise we're all going to be in major trouble as we get deep into our retirement years. Obviously, withdrawal rate. There's a lot of studies that have been done as to how much money can I take out of my retirement income in order to make ends meet. Am I going to be able to get to where I need to go? And is that income going to be sufficient to maintain my standard of living in the future? So we'll discuss that as well. And obviously, last but not least is long-term care. The fact that people are living longer today, that's a good thing. The fact remains that although people are living a lot longer today, it doesn't mean they're going to be any healthier. As a matter of fact, there's a very high probability that most of us are going to need some kind of long-term care planning at some point in time in the future, and you'll see that very soon. Now, let's talk a little bit about something that's very dear to me. And this is a question that I ask every single one of my clients, whether I engage them over the internet, that I do quite often, or if they come into my office for a one-on-one meeting, or they have been highly referred to me by a satisfied client or friend. But the one question I ask of them is, what percentage of your income do you want taxed in retirement? Do you want 100% of your income taxed in retirement? Do you want 50%? Do you want 0%? Do you want anything in between? By the way, I've been doing this for almost 28 years. I have never had a single client walk into my office or engage me over the internet in which they have said to me that they would want 100% of the income to be taxed in retirement. You know what the answer is? The number one answer I get every single time out is 0%. The sad thing about that is that although they're telling me that they don't want any of their retirement income to be taxed, they're doing totally the opposite. So what they want and what they're going to get are going to be two different worlds, and we're going to be addressing that tonight as well. Now, I always like to share some economic thoughts. I do a lot of reading, so I pay attention to a lot of financial articles and a lot of books that are very critical, from a business standpoint. One in particular is Will Rogers, a famous cowboy back in the 1920s. He was a self-made millionaire. And Will Rogers said many years ago, he said that it isn't what we don't know that gives us trouble. The trouble comes from what we think we know that just ain't so. There's a tremendous amount of information in the marketplace. If you go on the internet, if you Google any item, you're going to be able to receive a lot of information. One of the things that I tell a lot of my clients is that there's more information today in the marketplace than ever before, yet Americans are worse off than they've ever been. So information without education always, always, always leads to failure. My job as a financial advisor is to be able to save my clients from themselves and be able to gather all that information and truly decipher, what is good information and what is bad information. By the same token, Daniel Bernstein said many years ago that the greatest obstacle to discovering the shape of the earth, the continents, and the oceans was not ignorance. It was the illusion of knowledge. Back in the 1400s, everybody thought that the world was flat. And because they took that bay and they said, okay, it is what it is, no one ever did the due diligence to explore whether the world was actually flat or not, except very, very few people that decided to challenge that theory and that thesis. Obviously, back then, if you didn't think that the world was flat, it could have actually cost you your life. And a lot of people died along the way by creating that sense of urgency that perhaps there was something else in the world that they didn't know about. So I am glad that somebody took the liberty to follow on that path. Now, one of the main areas that we're going to have to deal with in the future of retirement is what I call a fast approaching train wreck. And for many of us, taxation and inflation, and although there are many other eroding factors that we're going to talk about tonight, but the major two eroding factors that we're going to have to deal with is taxation and inflation. And taxation is going to come to us from many different ways. But for instance, let's do some calculations here and let's understand what's going on as far as our government and our country is concerned. The unfunded liability for Social Security and Medicare is currently at $120 trillion and counting. Actually, you can get this information if you happen to go online. Just go to the usdebtclock.org, and it's going to give you a whole spectrum of everything that you see there. Actually, I'm going to show you right now what that spectrum looks like, and you're able to see there that debt clock and how it is moving second by second and minute by minute. So it is very, very critical that all of us can get to understand that. Along the way, we also need to realize that the US national debt is currently at 19 trillion and counting. Actually, we're a lot closer to 20 trillion and counting than we've ever been in our lives. So between the unfunded liability for Social Security and Medicare and the national debt at $19 trillion, we have a train that's doing 200 miles an hour and it has no brakes, and no one is going to be able to stop that wreckage at some point in time in the very near future. Our national debt increases by $2.7 billion per day. That's an astronomical number. In 1912, the federal government was actually only at 2% of GDP. Today is 23% of GDP. It means that the government has continued to get bigger and bigger and bigger to a point that it's going to eventually going to explode in a way that we don't want it to. Spending is a bipartisan problem, so it really doesn't matter whether you're an independent, you're a Republican, you're a Democrat. Everybody has been spending a tremendous amount of money at the government level, and that's going to be a major, major concern for all of us. What else is happening? Where's the money going to? Well, Social Security is taking about 20% of all that debt, Medicare 12%, Medicaid almost 7%, and national defense almost 19%. And then with whatever is left, we're going to have to pay everything else. The US debt as a percentage of GDP equals 138%. The only country ahead of us is Greece. Now, how many of us want to be Greece? None of us want to be Greece in the world. But then we're starting to move closer and closer in that direction. The unfunded liabilities are increasing every single year by $4 trillion. So what I'm trying to tell you is not to scare you, but is to hopefully get you to see the light as to what's going to have to happen in the very near future, and actually within the next 10 years, if we're going to be able to attempt to survive this major storm and or train wreck. The CBO, the Congressional Budget Office, estimates that the US debt as a percentage of GDP will be 225% by the year 2040, and that's just around the corner. There are 10,000 baby boomers retiring every single day for the next 14 years. Now, the baby boomers, just so you'll know, is a generation of us that were born between 1946 and 1964. There are 10,000 of us retiring every single day, and we're going to continue to do so for the next, for almost a decade and a half down the line. Medicare Part B and D receive 75% taxpayer subsidy, and that's also creating additional pressures. 95% of Americans get that. And we spend double per person, and that's about $8,500 a year in healthcare compared to any other industrialized nation in the world. The US government loses $1 trillion annually to tax deductions and exemptions. 60% of Americans pay more in payroll taxes than they do in income taxes. As a matter of fact, 40% of Americans pay no tax whatsoever. 20% of Americans receive absolute rebates. An absolute rebate is when you don't pay any taxes, but you are so poor that you actually get money back from the government, from the IRS. So 40% of Americans don't pay taxes, 20% of Americans get actually a rebate. So there are very, very few Americans who are actually paying taxes in our country as we move forward. US government spends more in national defense than all of our allies combined. And that's about almost $700 billion a year. Is that a good thing? Is that a good, bad thing? Well, it depends on what side of the aisle you're on, but it's a major issue that we're going to have to deal with. So the big issue of Social Security, now for many of us that are in this call, they're in our 40s, 50s, and perhaps early 60s, and even 70s, we're not going to have to deal so much with this. But the next generation and many other generations that follow are going to have to deal with this. Now, the problem with Social Security is that it is a pay-as-you-go system. So back in 1935, when the Social Security Administration and the government created the Social Security Administration, the ratio was 42-1. For every 42 Americans who were employed, one was retired. As a matter of fact, one of the major reasons why we made retirement age 65, we emulated Germany. And when in 1935, you know, very few Americans actually reached the age of 65. So when the plan was put together and Social Security benefits were going to be provided to Americans, obviously very few people were going to maximize the benefit of Social Security. So therefore, the system was very, very good, and it was projected to last a lifetime. Well, a lot of things have changed along those lines. In 1964, that ratio went from 42-1 to 10-1. In 1985, it went to 5-1. Today is 3-1, meaning that for every American that's retired today, every retiree, there are only 3 Americans working. And remember, it's a pay-as-you-go system. So we're actually paying today. Those of us that are employed, we're paying for those who are already retired. By the year 2026, the ratio is going to go to 2-1. So Social Security is going to have to change. We continue to kick that can down the street, but at some point in time, you know, you can borrow from Peter to pay Paul, and everything is good until Peter runs out of money, and then things are going to start happening to Paul that are not going to be very good from a financial standpoint. Now, for those of you that don't know David Walker, he was the Comptroller General of the United States, and he was in charge of the Government Accountability Office. Now, pretty much he was the CPA for the US government. And he quit the government in 2008. And before he quit, he went in front of Congress and he said, guys, I have some really, really bad news to you. Based on current fiscal policy, which I have in my hands here, and I'm going to read to you if you want me to, based on current fiscal policy path and economic policy, future taxes will have to double or our country is going to go bankrupt. Now, for those of you that understand that statement, that is a very, very deep statement. We're actually living at one of the lowest tax brackets in American history. The lowest was in the very beginning when taxes were created in 1913 under the IRS code. Then they were lowered during the First World War because we needed to have more money at that point in time. And then ever since President Reagan took power, taxes have been reduced. And today we're at the third lowest marginal tax bracket in the history of our country. And David Walker walked into the Congress and said to them, if you don't double taxes, we're going to go bankrupt. That's a major, major problem for all of us in the United States. By the year 2020, 92 cents out of every dollar, and that's only 3 years down the line, 92 cents out of every dollar that we generate is going to go to pay for Social Security, Medicare, and Medicaid, and the interest on the national debt. The additional 8 cents are going to have to pay for everything else, and you know it's not going to be enough. Every year that tax increases are avoided, it raises the national debt by $4 trillion. And that's a head-on collision. And we're sitting on that railroad track, and we're not doing anything about it, and the government will do something about it in the next 10 years. I understand that President Trump wants to reduce taxes, but it's going to have to be done under what is known as a Budget Reconciliation Act, which means that it's only going to last for 10 years. So once the Trump administration is out of power, whether they stay in power 4 years or maybe 8 years or whatever, 10 years is the most they'll go, things are going to change. And the taxes are going to be so bad and the debt is so incredibly high that we're not going to have any other choice but to raise taxes in the future to a very, very high level. So when it comes to taxes, I try to make it look, because the debt in our country, when you look at it, I remember when I was growing up, the debt was in the millions, and when I got into my mid-30s to early 40s, now the debt got into the billions of dollars. Today it's in the trillions. So for many of my clients, it's very difficult for them to truly understand, what's the difference between a million, a billion, and a trillion. So I try to figure out a way that I could explain it that would make sense, to many of you on the call today. How long was a million seconds ago if we're using millions as seconds from a timeline standpoint? Well, that was about 12 days ago. Well, if that's the case, how long was a billion seconds ago? This actually was 32 years ago. So there's a big difference between a brand newborn baby that is 12 days old versus a 32-year-old man or woman. It's a big difference between the two. The big question is, well, what is a trillion seconds ago? And if you do the math, it's almost 32,000 years ago, and there was very little, if any, human civilization on Earth. That is the main difference between a million, a billion, and a trillion. Now, the challenge is that the law of large numbers just blurs reality. And the biggest issue for us is that politicians don't understand the concept of economics, and they just keep spending money and spending money and spending money with no end in sight. Now, let's talk a little bit about critical eroding factors. Now, obviously, if you understand all the stuff that I have shared with you regarding taxation, there's a very, very high probability that taxes are going to have to double in the next 10 to 15 years at the very, very most. But along the way, you're going to have to deal as Americans and as retirees, and I'm going to have to deal as a retiree with the critical eroding factors that we deal with every day in our lives. The problem is that when we get to retirement, the impact is going to triple in comparison to today. So for most of us on the call, you're going to be earning a tremendous amount of money. And it doesn't matter whether you are young in the business or young as an employee, you're earning $2,000 to $3,000 a year, whether you're earning $2,000 to $3,000 a month or $15,000 a year. There's a high probability that most of us on the call have already either earned a small fortune of income and revenues, and for many of you, you will continue to earn a lot of money for many, many years to come. I have many business owners that are clients of mine that are earning 7 figures every single year. Now, it's not how much money you make, it's how much money you keep. So we're going to talk a little bit about the major eroding factors that we're going to have to deal with. At the end of the day, there are only 4 things you can do with money. You can spend it, you can save it, you can give it away, or you can transfer it. Now, most everyone understands, saving, spending, and giving the money away. You can give it away to your family, charities, and so forth. Where most of our clients have an issue with is they have a difficult time understanding that transfer section on the bottom left-hand corner. And that's the one that we try to maximize the benefit that we provide to our clients on an ongoing basis. And I'm going to share with you what I mean by that in a minute. Now, when it comes to money transfers, there are 3 major parties that are always looking at ways in which they can take our money away from us. Obviously, the US government is a major one, and they do that through what? Primarily taxes, and that's pretty much what it is, and we pay all kinds of taxes that you'll see in a minute. The second would be financial institutions through services, fees that they're going to be charging us on a regular basis that are going to have a negative impact on the growth of our wealth. And then last but not least, you have another major pool of people. They are trying to get our money on a regular basis, and those are large corporations. And what is it that they do for us? Well, they're providing advertising campaign every single day of our lives. We can't turn our faces in any one direction without seeing an ad campaign trying to sell us something in which we're going to be parting with dollars in our personal economy, and we're going to give it away to either large corporations, financial institutions, the US government, but most of it and a combination of all of them. Now, we need to understand how the rules of engagement work when you're a financial institution, because we have to use all of these companies. We have to pay taxes to the government because they need to maintain this country alive and well. We have to pay fees to financial institutions because they're going to be hosting our monies and our finances for the future. And we're going to have a lifestyle where we're going to have to pay money to major corporations in order to maintain our standard of living. But if you understand the rules of engagement, you'll understand how it is that you can do to minimize that damage and be able to maximize your business opportunity. Now, financial institutions go by 4 major rules. They want your money. They want your money systematically. They want you to hold on to your money for as long as possible. And then they want to give it back to you as little as possible. A 401k is a traditional example of something like that. A 401k was put together for Americans to put money away for retirement planning. When you put your money away, you're going to keep it there for a long term. You're going to continue to make contributions to your qualified plans or IRAs or whatever it may be on an ongoing basis. They're going to want to hold on to your money for as long as possible. And then they want to give it back to you because you're going to want to take that money out, not in a lump sum, but you're going to want to take it out on an annual basis, so the rest of the money will remain with the financial institutions where they can charge fees on a daily basis, depending on the type of investment portfolio that you have. What they don't want you to know is how to use economic straddles and different straddle techniques that will allow you to create an efficient management of your assets by giving a lot less away and keeping more of your money on an ongoing basis. Now let's talk a little bit about your personal economy. Your personal economy is divided into three sectors. You have what we call, in my firm at Cambridge and the other firm, Camelot, your accumulated wealth. You have your lifestyle wealth, and then you have your transfer wealth. Now, the majority of advisors that we compete against, although in reality we really don't have a lot of competition out there in the marketplace, but the majority of the clients that we compete with, they're very much interested at grabbing and gathering your accumulated wealth. And then lifestyle wealth, they may want to do a little bit there so they can get some more from there. They never ever pay attention to transfer wealth. I think it's because A, they don't have the educational background to understand transfer wealth, and B, the majority of the institutions that they work for do not educate them in that respect. As an independent firm, we're not married to any financial institution in the marketplace. We're actually married to our clients from a business standpoint. So we do not have to abide by those regulations and those rules. Now, you would think, what is accumulated wealth? Well, it's primarily all the stuff that you own. Your 401ks, your IRAs, your savings, your investment vehicles, your real estate, everything that it's yours that you own, and that's your accumulated wealth. Your lifestyle wealth, well, that's pretty much your lifestyle. You know, I have done budgeting for many of my clients over the years, and they want to reduce their budget, and they want to spend less, and they want to go out less. Well, doing a budget is like trying to go on a diet. You know, the Americans have gone on diets all of their lives, and they continue to get heavier and heavier every day because you can only do it for so long. Unless you make a paradigm shift in how you think about spending money, will you be able to make a dent on that. One of the interesting things that I can tell you from a business perspective is that I have a tremendous amount of clients that make a lot of money, yet they don't understand how money works. And that is something that is very critical. In addition to that, you have your needs and desires. You know, one of the things that we try to educate our audience on is that, you know, we all need an automobile, but we don't need to drive a Mercedes or a BMW or a Jag. So there are wants and needs, and there are desires as well. So you have to be able to understand in a spending economy how it is so you can limit those and still have a wonderful lifestyle for life. Transfer wealth. This is where specialty lies. And this is what we call the Sutton Law. And for those of you who don't know who Willie Sutton is, he was a very famous bank robber back in the 40s and 50s. Now, he wasn't famous because he stole a lot of money. He was famous because he would get caught all the time. And I remember one time reading a book about Willie Sutton. You know, he was being escorted to the courthouse from the prison cell because he was going to go in front of the judge. And the police officer that were escorting Willie Sutton to the courthouse basically asked him a question. Hey, Willie, you know, how many times have you been caught? And Willie said, I don't know, maybe 5, 6 times. He says, well, you get caught all the time, so you're not really a bank robber, so you're not really a good one. So why do you keep robbing banks? And Willie said, well, that's where they keep the money. So the bottom line is, wherever you accumulate wealth, you know, those 3 bodies of governmental and private sector features that I told you about, the government, financial institution, and large corporations, they're going to find ways to get at your money. So obviously, there's a lot of stuff that you can do. Auto financing is a major transfer of wealth. And we'll do another workshop at some point in time in the future in order to deal with that, and we'll use special calculators so you can see the amount of money that you're transferring to financial institutions when it comes to auto financing. Mortgages, another major source of financing. Obviously, taxes and fees, tax interest volume, and obviously opportunity cost. We don't have time today to discuss those, but we'll be able to do those at some point in time in the very near future. But just bear in mind that there's a tremendous amount of transfer that takes place, And when we work with our clients on a one-on-one basis, we're able to itemize all their transfers of wealth, and we actually come up with a number. And if we're able to reduce those numbers by anywhere between 50 and 75%, they're actually recapturing money that they didn't even know that they were losing from a business standpoint. Now, let's talk a little bit about some of the challenges of income. Income is very challenging, especially in the United States, because of the fact that, we're spending society. So if you look at your income overall, out of every dollar you make, anywhere between 40 to 50 cents is going to go to pay for taxes. Yes. I know you're going to tell me, Bert, I'm in the 25% tax bracket, or I'm in the 30% tax bracket, or I'm in the 20% tax bracket, so I don't pay 40 to 50% in taxes every single year. My answer to you is yes, you do, and you'll see that in a minute. Now, debt is about 30 to 40%. So when you factor the average American family, their mortgages, their credit card, their auto financing, their financing school loans and education, 30 to 40 cents out of every dollar is going toward debt. Lifestyle, a lot of Americans are spending anywhere between 20 to 30 cents on the dollar. If you happen to have a lifestyle, you may be spending even more than 30 cents on the dollar. And then what is really truly sad is that the majority of Americans are saving anywhere between 0 and 10% of their income. Actually, I would argue that 10% of their income is more toward, as I get closer to retirement years, and in the first 10 to 15 years of their working lives, they may not be saving any money at all. And those are the major problems that we see in the thousands of plans and economic models that we have done for clients over the years. Now, there are 10 major wealth eroding factors that I talked to you in the very beginning that we're going to be spending time on. But today we're going to be spending a lot of time on taxes and longevity. So we're not going to be spending a lot of time on the rest of them, but I wanted to name them there because it's critical that you understand. To us, the major two eroding factors that most of us are going to have to deal with in the future is going to be taxes and inflation. Everything costs more every single year. And as a matter of fact, for those of you on this webinar, please bear in mind that inflation is not tax deductible. So if inflation is at 4%, depending on your tax bracket, you may have to earn 4.5%, 5%, or 5.5% in order to be able to offset the inflation rate after taxes. Now, stock market declines. Interest rate declines. I remember many of my clients that retired in the 1990s. They had $1 million portfolio back then, and they were on top of the world. They weren't going to have to work another day in their lives because they could take that $1 million portfolio, leave my firm some of it so we can continue to grow their assets, put the rest of it in a CD earning 6%, and they were generating anywhere between $50,000 to $60,000 a year. Have you guys tried to go to a bank today and see what kind of an interest rate they're going to pay you on a CD? They may pay you 1.5. Some banks may even pay you, 95 cents or 0.95%. So if you were earning $60,000 to $70,000, 20 years ago on $1 million CD, today you may be earning just less than 20,000. You're not going to have any choice but to invade principal, and eventually you're going to run out of principal, and then you're going to run out of money. Obviously, lost opportunity cost. This is a major issue that we deal with. Financial expenses, loans, interest charges, technological changes. You're always going to want things that are technologically inclined in the future. Obviously, you're going to get the newest gadget 5 years from now, 10 years from now, 15, 20 years from now, and the technology is growing very rapidly in our country. Obviously, planned obsolescence, wear and tear. If you own a home, you're going to have to replace it. You're going to have to replace, air conditioning. You're going to have to replace refrigerators. You're going to have to replace the wear and tear in your automobiles. You may have to replace your automobiles 2 or 3 times during retirement. and obviously lawsuits for many of us in the business marketplace. We do a lot of asset protection for our clients, which is very critical for them to protect their assets and avoid any litigation that may take their income away. Now, I want to talk to you about the first principle of finances. This is something that we want to educate our clients, and we try to do so every time we engage our clients on a regular basis. Number one, we want to let our clients know that everything in this country is financed. And the reason for that is the following. I get clients of mine that tell me all the time, Bert, I don't finance anything. I have plenty of cash, so I pay cash for everything. Well, let me clear this up once and for all. Everything is financed. Either you're paying interest to someone else when you borrow money, or you're giving up interest when you're paying cash. So regardless of which side of the fence you're on, everything is being financed. Now, obviously, when you're using debt, you're borrowing from your future earnings because you have to take a percentage of those earnings and pay your debt. But then again, when you pay cash, you're actually borrowing from your past savings. Now, the big question is, well, which way does it make more sense? Well, it depends on the arbitrage between the interest payment that you're going to have to make or the interest payment that you're going to be giving up from a business standpoint on your investments. Now, obviously, wealth transfers occurs, as we already covered, in just about every area that you see there. And this is one area that I want to focus on when we engage clients, because we see a tremendous amount of transfers on a regular basis. Now, how do we see the transfers? Well, when we do an economic model where we get to see through a telescope as opposed to a microscope how our clients' finances are working, that's when we have the ability to truly determine how it is that money is being spent. And let me give you a prime example of what I call one step forward, two step back. Typical client walks into my office or engages me over the internet. I review their portfolio, they send me all their stuff, I create their economic model, and this client is making $100,000 a year, but they're spending about 34.5 cents or $34,500 a year in debt servicing. Mortgages, automobiles, student loans, all kinds of other property financing, whatever it is, they're spending about 34.5 cents out of every dollar in financing items on a regular basis. But they're very proud of their 401k account because they have $150,000 in their 401k, and they have been averaging over the last 2 to 3 years, around somewhere around 8 to 10%. So in this case, it's 10%. So they have $150,000. They're averaging 10% return, so they have a $15,000 increase in their 401k, and they're very happy. But they're very happy because they're looking at their assets and their personal economy through a microscope. They look at their debt all by itself, and then they look at their assets all by themselves. They don't look at them through a telescope. So in this scenario, this is a reason why I call it a one step forward and two steps back. Why? Because they're actually spending $34,500. They're generating $15,000 of that back in rates of return on their 401k, but they still have a negative $19,500 in their personal economy. So that is one step forward by generating a 10% return on their investments, and then two steps back by losing almost 20% every single year. And they do this every single year, year after year. Now, what would happen in a year where their 401k doesn't make any money or their investments don't make any money? And their investment accounts could actually even lose money. Then this negative number of 19.5%, I've seen it as high as 85%. And that's a big, big number. And I've seen it for a number of years consecutively. So now let's talk a little bit about taxes and retirement. Now, hopefully you guys are not taking any type of medication, because this can really get to you. And this is something that is very exciting for me to communicate, but is very, very sad for many of my clients, because they wish we would have had this conversation 15 to 20 years earlier. So let's talk a little bit about taxes and retirement. Now let's look at all the taxes that Americans pay. And this is why I was sharing with you earlier that the average American spends between 40 and 50 cents of their dollars, 50 cents out of their dollar in taxes. And here's a reason why. Because most of Americans always only think of taxes as federal income taxes. But you have federal income taxes, you have state income taxes, you have Social Security taxes, you have Medicare taxes, you have payroll taxes, you have taxes that you pay on your property taxes if you have a mortgage and you own real estate properties. You obviously have Medicare tax. You have all kinds of taxes. If you have investments, you're going to have capital gains taxes, short-term capital gains. You're going to have dividend taxes. So when you add all of those taxes, when you add the tax volume, the average is anywhere between 40 and 50 cents out of every dollar that you generate as income from a business standpoint. Now, anatomy of taxation. Obviously, we do a lot of taxation planning for our clients, in addition to the accounting services that we can provide for them. But you have, most Americans just allow their tax to compound. There's compounding, there's netting, obviously there's flattening of taxes, and there's also pay down. When we work with our clients, what is our number one goal? We want their account values to compound year after year, but we don't want our taxes to compound. We want our taxes to remain flat at the very, very least. And that's where the anatomy of taxation calculations that we do with our clients come into play, and you'll see that in a minute. Now, understanding qualified plans. And by the way, we do a lot of pensions in our firms. We do pensions at the corporate level. We do a lot of money management and investments for our clients, whether they have 401ks or IRAs or whatever that may be. But at the end of the day, it is very critical to understand qualified plans. And the first thing to understanding qualified plans is that taxes are not saved. They're actually postponed, okay? Or to some extent borrowed from the IRS. Now, I have had a lot of discussions with accountants over the years where they say, well, I'm going to recommend that the client puts, $10,000, $15,000 away in a qualified plan, sometimes maybe $40,000, $50,000, or $100,000 in a qualified plan, depending on the type of plan, because the client is going to save on taxes. And I have had to correct them many times and let them know that they're not saving taxes on behalf of their clients, they're postponing the tax. And the problem is that when you postpone the tax, you also postpone the tax liability, because no one knows where taxes are going to be in the future. We all know they're not going to be any lower than they are today, obviously, and that's a fact, but how high are they going to be? So when you postpone that tax, you postpone the liability as well. Now, qualifiers are controlled by the IRS code, so they can make all the changes that they deem necessary to it. There are distribution penalties to all qualified plans. You have the 59.5 rule and the 70.5 rule. 59.5 rule deals with premature distribution, and then the 70.5 rule deals with the required minimum distribution. On the 59.5 rule, if you pull money out prior to age 59.5, unless there are exigent circumstances that the IRS may give you a break on, you're going to have to pay taxes and a 10% penalty. And then if you don't take money out of your qualified plan after age 70.5, you may have to pay a 50% excise tax penalty on the distribution that you were supposed to take out that you failed to take out, plus all the taxes that you're going to have to pay on that distribution as well. So only between the ages of 59.5 and 70.5 can you do whatever it is you want to do with a qualified plan without having the government get involved. IRS determines the tax liability upon distribution. And at this point in time, for those of you and those of my clients who are putting money away on a regular basis, I educate them on the fact that we want to make certain that we can control that tax liability as much as we possibly can in the future. There are no deductions in qualified plans for investment losses. Distributions are taxed as ordinary income. So depending on what taxes are going to be in the future will determine what your tax bracket will be. Tax volume increases 8 to 12 times along the way. There's lack of flexibility in distribution handcuffs. You cannot do anything with your qualified plans until you hit age 59 and a half. And if you do, you're going to have to pay the piper and pay penalties. If you happen to borrow from a 401k, you're going to have to repay those dollars within a 5-year period. Most important, those borrowed funds are going to have to be repaid with after-tax dollars, and that creates a double taxation issue as well. And now we're going to get into what we call our Cambridge distribution model. And this is one of the areas that we really try to educate our clients on. Most of our clients, when they come to see us for the first time, they bring us all their accumulated statements, all their statement of wealth, their 401ks, their IRAs, their investment accounts, their stocks, their bonds, their mutual funds, all of this stuff. And it happens to be all in one pot. And when it comes to retirement distribution planning, you have to think totally different. You actually have to make a paradigm shift in the way you think. And the way that we do that at Cambridge is we have set up 3 separate buckets of distribution, what we call the go-go years, the slow-go years, and the no-go years. The go-go years are for clients that are retiring, at the age of 65, and they have a 10-year window in which they're going to be enjoying life. They're going to be doing a lot of traveling. They may be spending as much money in those 10 years as they did while they were working, perhaps even more. I deal with a lot of public employees that they get to retire, public safety employees, they get to retire in their 50s. So we create a 4th bucket of distribution planning for them, but we're not going to talk about them today on this call, unless some of you may be public employees in your communities as well. Now for us, 65 to 75 is your go-go years. Once you hit your mid-70s to about your mid-80s, it becomes a slow go. You're not traveling as much. You may not be as healthy as you were before. Perhaps you're staying home a little bit more because you want to take care of the grandchildren and so forth. Once you hit your mid-80s is what we call no-go. You're hoping to wake up on the green side of the grass every day. Obviously, hopefully you're going to be healthier. You may have some involuntary expenses because, your health cost is going to increase and you're going to have to find ways to pay for that. So it's going to create a major issue. But the investments that you have in the 3 buckets are not the same investments in bucket 1, 2, or 3. You have to be able to diversify it from a business standpoint. Now, there are 4 tax boxes that we deal with for our clients. And basically, your money is taxed in 4 different ways. Now, on the top left-hand corner, you have the area of taxation that everything is taxed. You put the money in, it's taxed. Every single year, you get a 1099 from the IRS, in which you're going to have to pay taxes, or the financial institution, and then you're going to have to pay taxes to the IRS on that. And then when you take the money out, you're going to have to pay taxes. Now, those are your traditional mutual funds, checking accounts, savings, CDs, and so forth. Now, just because everything is taxed doesn't mean that it's a bad box, but it's a box that you have to be very careful with. The second one is the bottom left, which is what we call the TDT box, which is a tax-deferred tax box. And this is a tax where we find a lot of the annuity vehicles. You put the money in after tax, the money grows tax deferred, and then when you pull the money out, you have to pay taxes on that growth as well. Now, real estate goes in there as well, but it gets taxed from a different perspective. But we have to be able to understand on that particular side of the ledger is that every time that the IRS allows you to defer something, they're going to put certain penalties on you. And one penalty there is going to be the 59.5 rule. So if you pull money out of those plans, unless it happens to be in real estate, you're going to have to pay a 10% penalty to the IRS. The bottom right is the one that most of our clients understand. Most of the people on this call understand. And that's a box that we call the defer, and tax box. That's primarily your qualified plans, your IRAs, your 401ks, and so forth. It means that you put money away on a pre-tax basis, the money grows tax deferred, you're going to be able to pay taxes on all that money on the way out. So the big question for most of my clients is, would you rather pay taxes on the seeds or would you rather pay taxes on the harvest? Most of the clients want to pay taxes on the seed and not on the truckloads of harvest. And then the last box, which is the least understood box in the IRS code, is the one that is a tax deferred and free box. That means that the money going into that box is after tax. You have already paid taxes on the money that you contribute. The money grows on a tax deferred basis, and then you're able to pull the money out tax-free. Now, those 4 boxes create actually 3 buckets. So we have the taxable bucket at the bottom, then to the left, top left, you have the tax deferred bucket and the tax-free bucket. What is critical for us to do when we work with our clients, and remember, the entire spectrum of this workshop is how to create and maximize retirement income. And at some point in time, we have the ability to create tax-free, a tremendous amount of tax-free retirement income for the majority of our clients. So from a business standpoint, we have to be very careful in how we manage these 3 boxes. We only want to have certain assets in the taxable bucket, and we want to make certain that we can limit that to the most amount possible. Same thing with a tax deferred bucket, but we want to maximize the tax-free bucket from a business standpoint. How do we do that? Well, here's how the 3 basic buckets work. So for instance, in the taxable bucket, what we strive to do with our clients is to maintain your emergency fund and your liquidity for opportunities or business ventures or whatever that may be to no more than 6 months of expenses and taxes. Anything above that is way too much, and you're paying a lot more in taxes than you should have to begin with. By the way, the majority of clients, before they started working with me and my firm, were paying a lot more taxes than they needed to legally. And one of the things that we try to do is we want to make certain that they legally avoid as many taxes as they possibly can, because there's a big difference between tax avoidance and tax evasion. We never want to get into a tax evasion scenario. Now, the tax deferred bucket, that's where all your qualified plans goes, your 401ks, your IRAs. And what we want to do is we want to contribute to those accounts, and we want to do internal rate of returns calculations on those accounts to make sure that the distribution out of those accounts do not exceed the standard deductions and or any other qualified deductions that our clients may have during retirement years. And it takes a tremendous amount of telescopic view and calculations in order to arrive at the correct number. And then last but not least, we have the tax-free bucket. Any overage, any excess out of the taxable bucket and the tax-deferred bucket should go into the tax-free bucket. We should be able to maximize the tax-deferred bucket based on the IRS code. And there are certain codes that we will address in a minute regarding the tax-free bucket. Now, most of the clients have been reading a lot of information and have worked, many of our clients have worked with other advisors in the past, in which, you know, the advisors are saying to the clients that, you know, more than likely they're going to be in a lower tax bracket. Well, I have news for all of you on this call. The only way you're going to be in a lower tax bracket is if you have been a financial failure for your entire life. If you haven't done that, if you've done fairly well for yourself and your family, there's a very high probability that you will find yourself either in the same tax bracket that you are today, but more than likely in a much higher tax bracket because I actually deal with retirees today that were clients of mine before they retired, and they're paying more in taxes today than ever before because they failed to listen to my advice. And now they want me to go ahead and try to fix all of those issues and concerns. And we're doing that, but it takes time in order to do that. So let's talk a little bit about pre-retirement deductions. You know, while all of us are working, we have certain deductions. We have mortgage deductions. Obviously, you have your deductions for your children. Your children are not only a tax deduction, but you also receive a tax credit for them. So you get a double whammy benefit by having your children along those lines. Obviously, qualified plan contributions, you're taking deductions as you're putting money away. And then obviously, most of us are making contributions to our charities. Now, the problem with that is that the majority of those things are going to go away at some point in time in the future, because you know the hope of every American is to have a mortgage and have that mortgage paid off by the time they retire. So mortgage deduction is gone. Hopefully your kids are going to be out of the house, although that is happening less and less as we move forward into the challenges of the 21st century. But you're not going to be able to claim them as a deduction anyways, or an exemption, so you don't have that. And obviously, because you're no longer employed and no longer making contributions to your qualified plans, you're not able to put money away. So even if taxes were not to go up in the future, the fact that your tax deductions are going to go away is going to increase your liability for most of us on this call and the majority of Americans in the marketplace. So we need to truly have an understanding of what are the federal income tax-free sources that the US government gives us on a regular basis. And here they are. And there are 4 of them that are free from federal income taxes. And there's nothing else. You don't have 20, you don't have 30. There are thousands and thousands of products and services that are sold in the US every single year. And there are only 4 products that do not pay any federal income taxes on distribution. Those are your Roth IRAs, your Roth 401ks, your municipal bonds, and what I call a PERP, which is a personal insurance retirement plan, which hosts as a foundation, as a chassis, a life insurance contract. So other than life insurance, Roth IRAs, Roth 401ks, and municipal bonds, there's no other vehicle in the IRS code that allows you to pull money out on a tax-free basis. Now, what's interesting to note is that although there are 4 federal income tax vehicles that allow for tax-free distribution without having to pay federal income taxes, only 3 of them are tax-preferred vehicle. And what do I mean by a tax-preferred vehicle? A tax-preferred vehicle is a vehicle that distributes income that not only does it not have a negative impact on the income that the account produces, but most important, it doesn't have a negative impact on anything else in the portfolio outside of that account. And under those scenarios of the IRS code, there are now only 3 vehicles that will allow you to maximize your tax-free income in retirement without having to pay any taxes, not only on those assets, but most important, on any other income that you may be receiving. And those are your Roth IRAs, your Roth 401ks, and last but not least, your PERP, or personal insurance retirement programs. That's it. Nothing more, nothing less. Now, once you hit retirement age, you have all, and we have all been paying taxes on an annual basis on income. We pay for Social Security and Medicare. We pay 7.65%, on that. Out of the 7.65%, 7.20% goes to pay for Social Security, and 1.45% goes to pay for Medicare. Now, we pay that Medicare tax of 1.45% for all the income that we generate for that year, and that's in a unlimited amount. On the Social Security, we do have a taxable wage base that gets increased by inflation. This year is north of 117,000. So once you go above that threshold, you don't pay that 6.2%. But up to that threshold, you will have to pay 6.2% taxes plus the 1.45. So at time of retirement, when you start taking distribution as a family, husband and wife, for Social Security benefits, the big question is, well, do you have to pay taxes on Social Security benefit distributions? Interesting enough, the majority of my clients that come to see me have always felt that they would never have to pay taxes on Social Security benefits because they already paid the tax when they put the money in. Well, that's totally erroneous. What the IRS does, and what I do for many of my clients when we provide accounting services, is we do what is known as provisional income calculations. And what provisional income does, going from left to right, it takes 50% of the Social Security benefit that family is receiving, husband and wife filing jointly on an annual basis, 50% of that income. So if they're generating, $60,000 in Social Security benefits, we take $30,000 of that. We add that on to their ordinary income that they're generating, okay, from any type of income that they're generating from in part-time work or business-related income. We then add to that dividends and capital gains to that equation. And then last but not least, we add non-taxable income. And that non-taxable income is that income that was generated from those municipal bond funds that, although they did not pay taxes as long as the client bought them in the state where they reside, but now that income is going to be added on to the formula and to the ultimate calculation of this provisional income in order to determine what percentage of Social Security benefits are going to be taxable. Now, if you're within the threshold, then no Social Security benefit will be taxed. If it's a family filing jointly and they're between 34 and 44% of taxable income after doing all of these calculations, then 50% of those Social Security benefits are going to be taxed. Anything above that 44,000 threshold for a husband and wife filing jointly will be taxed at 85%. So all of a sudden you're a retiree sitting around, 85% of your Social Security is going to be taxed. 100% of your IRA distribution, your 401k distribution is going to be taxed. 100% of your ordinary income is going to be taxed. 100% of your capital gains are going to be taxed, not only for you, but also for your spouse. And then you're losing your standard deductions and many of the other exemptions that you were getting while you were employed. Where do you think your taxes are going to be in the near future, even if taxes were not to go up? We have that train wreck coming. It's doing 200 miles an hour, and the majority of Americans are just standing on the railroad track and not doing anything along those lines. Now, just to give you a little bit of education as we get toward the end of our presentation on how these tax-free accounts work, let's talk a little bit about Roth IRAs and Roth 401ks. Well, obviously, the money grows on a tax-free basis, and that's what the code says. You're also going to have the ability to distribute that money on a tax-free basis. If it's a Roth IRA and a Roth 401k, you're going to have limited contributions because the IRS is going to limit the amount of money that you can put in your Roth 401k and your Roth IRA, because I don't want all your income to go in there because they need to get revenues to pay for all the messes that we're in today in this country. you're not going to have access to funds until 59 and a half. So you will have that 59 and a half rule like you would in a traditional 401k or IRA, but you're not going to have that 70 and a half rule, which means you can actually allow that money to continue to grow past the age of 70 and a half, and you're not going to be obligated to take any distribution out, and you're not going to suffer any penalties. So that's a major advantage over the traditional qualified plans. It triggers no Social Security taxes, so that is a very, very good thing, and is creditor protection under the code. So you can get sued and no one can take that money away from you. Now, municipal bonds, again, you have that tax-free growth of accumulated funds as well. You have tax-free distribution of the accumulated funds as long as you buy them in your resident state. You can have access to your money prior to age 59 and a half, so you don't have to worry about that 59 and a half rule as you would with qualified plans or the Roth IRA and the Roth 401k. You don't have that minimum 70 and a half rule, required minimum distribution, so that's a good thing. It does trigger Social Security income or taxation based on the provisional income calculation, so that's not a good thing of municipal bonds. And it has no credit protection. So that's something that we deal with on a regular basis. Now, the personal insurance retirement plan, which is the third leg of that stool that gives you the tax-preferred income distribution. You do get a tax-free death benefit because there's going to be a fee that is going to have to be paid for the insurance portion of the vehicle. But the rest of the money is going to grow on a tax-free basis. You're going to be able to pull it out tax-free. You're going to be able to transfer at death the entire amount and do it properly on a tax-free basis. You have access to your funds prior to age 59 and a half, as you would in a traditional municipal bond fund. You don't have that 70 and a half rule as you do in the Roth IRA and the Roth 401k, so it gives total liquidity from a business standpoint. It also is creditor protected in the state of Florida. For those of you that are not in the state of Florida, that are on this call from California and obviously New England states and Texas and so forth, you have to look at your individual tax rule for that state. But in Florida, it's all creditor protected. That's why everybody wants to move to Florida. It is self-completed in case of death or disability. You know, you're making contributions to your PERP program, and all of a sudden you have a major disability, you can no longer work, you have a stroke, you're paralyzed from the waist down. Obviously it is self-completed, it will continue to fund itself, something that you can't do with a traditional 401k or IRA. It does provide long-term care benefits because many of our clients are going to have a need for long-term care, and these contracts that we put together on behalf of our clients are designed not only to provide a death benefit if the client were to die or when the client dies in the future in order to protect the family enterprise as a whole, but it also provides long-term care benefit on behalf of the client, so the client can enjoy or have access to those funds in order to pay for medical expenses along those lines. It's got competitive rates of returns, no Social Security tax triggers whatsoever, which makes it very, very good from a business standpoint. And obviously there are 30 different types of commercial uses for these types of contracts. When we're dealing with PERP, after we do all the calculations for our clients and we identify what percentage of their income should go into the Roth IRAs or Roth 401ks, their qualified plans, we do, because we do make contributions to qualified plans, we also need to figure out how much of that income or those assets are going to go into a PERP program. And at the end of the day, you know, the insurance company determines the minimum amount that you can contribute to a PERP. The IRS determines on the bottom right-hand side the maximum that you can contribute. And then our company, myself, and our clients will determine what the optimum amount is. Just to give you an example, for instance, for a traditional client, 40 years of age, the insurance company says, look, you can contribute a minimum of, $1,300 in order to meet the insurance requirements, but the IRS says you can put as much as $56,000 into the plan. How much we put? Well, it depends on the provisional income calculation, how much income our clients are generating, their assets, what percentage of those assets do we want taxed in the future, and what percentage do we not. And then after doing all those calculations, then we are able to formulate a holistic plan that would allow us to maximize those benefits overall. Why PERP? Because it does a lot of the things that all the other plans do. So it's like having the sun, and then the plants are going to be all around. All the other plants that we formulate for our clients will be the planets going around the sun. Why? Because it's going to protect our clients from the risk of dying too soon, the risk of dying too long, the risk of living with a disability because of certain features that it has to provide long-term benefits. And because of its tax benefits, it does really assist with the eroding factors and inflation and so forth. And that is very critical from a business standpoint. Now, what are some of the retirement distribution challenges? Number one is longevity risk. People living a lot longer today. And those are the things that most of you on this call are going to have to deal with in the future. You're going to have to deal as you start to prepare to, where am I going to put all the assets? How am I going to do this? Am I going to do this all by myself? Am I going to hire an expert to help me with this? You're going to have to worry about three major areas. So a lot of areas in between, but there are three major areas. The risk of living too long, the risk of living with a disability, and the risk of living with eroding factors. Now, in the risk of living too long, let me just give you some basic statistics. Let's take a look at an average American family. They're husband and wife, 65 years of age, they're in good health. There's a 50% probability that both of them are going to be alive at age 85. That means they're going to spend 20 years in retirement at least. There's also 25% probability that one of them is going to be alive at age 92. It usually happens to be the female. Women have a tendency to live longer than men do, but also women have a tendency to have more disabilities than men do. In addition to that, when you look at income sustainment in retirement, a lot of the factual information and the studies that have been done dictate that 97% of all Americans, and I mean 97% of all Americans, are going to run out of income before they run out of life. In other words, they're going to be running out of income years before they run out of life, and that's a major, major problem. The second thing is that taxes and inflation is going to decimate retirement distribution planning for many of them. And for most individuals and Americans in the marketplace that retire at age 65, taxes and inflation will decimate the majority of their income in their first 10 years of retirement. And that's a major problem, and it's a very sad issue to deal with. And sadly enough, most retirees will only have Social Security benefits in retirement. Living with a disability, again, it's a fact of life. Hopefully, we all want to die on the side of the angels. We want to die in bed. We want to go to sleep tonight and not wake up tomorrow morning. Obviously, that would be the best way for us to go. My dad actually passed away that way. My mom died of cancer many years ago as well. And she went through a major disability that she had to deal. But my dad, died as well on the side of the angels from that perspective. But let's talk a little bit about long-term care needs and requirements. There's a 75% probability that a 65-year-old couple is going to have a need for long-term care in the future. Let's talk about the state of Florida. The cost of nursing home in the state of Florida is about $92,000 a year today, not tomorrow, not next week, not next month. Today is $92,000. It has been projected to go up to $295,000 in cost for nursing care in the state of Florida in the next 20 years. That's going to have a tremendous impact to family and care providers along the way. Now, obviously, for many of my clients, they're always asking about Medicaid spend down rules. And there are many rules. Every state is different. So depending on the state that you're from, you're going to have to go into that and deal with an advisor that can help you with that. If you're in the state of Florida and you want to deal with me, or the state of Texas or California, I'll be more than happy to help you along those lines. And I understand those rules very well. But the problem is that in Florida, there's an asset and income cap dilemma. So if you have too much money, you don't qualify for Medicaid, so you have to spend down your assets, and you actually have to live off your assets. So if you have a family member, husband and wife, the husband has a need for long-term care, that is creating a major problem for the surviving spouse, because the surviving spouse thought that they had enough money to make it to the end of the game. But if they have to use a lot of that money to take care of that spousal need in a long-term care facility or in a nursing care facility, then there's not going to be any money left for the surviving spouse once the other party passes away. Now, there are ways to do this, and again, you have to do it with plenty of time. You can do certain spend down techniques, as you see there. Spend down by choice. You can do transfer and wait. We're not going to go into any of those at this point in time. You can do personal service contracts. You can hire somebody, and kind of set those expenses for future needs. You can do Medicaid compliant annuity, which is a product that you can buy through an insurance company that will take those assets out of your estate for Medicaid purposes. You can actually do spousal refusal. Now, I have never had any spousal tell me that they're going to refuse or opt out of taking money out of their account in order to fund a long-term care need for their significant other after 30, 40, 50, 60 years of marriage. And you also have what is called pool trust, but we don't have the time tonight to be able to do that. Now, living with eroding factors, what are the tax planning failures that most of us are going to have to deal with? Well, obviously, tax planning failures are going to decimate about 40% of all income in retirement in today's rates. This is only going to get worse. This is not going to get any better. Inflation management. As I said before, inflation is not tax deductible, and it will reduce purchasing power by as much as 65% in 20 years. 20 years from now, $1 is going to be able to buy 35 cents. So the same dollar today will only buy 35 cents worth of goods and services 20 years from now. How are you going to be able to deal with that without proper planning? And then obviously market and interest rate volatility will also create a major problem for Americans, because you may have no choice to invade principal at a point in time where the market has dropped 10, 15, 20%, but you have to be able to maintain your standard of living. Now, let's talk a little bit about investment strategies. Most of the clients are always talking to me about averages. I've been averaging 10%, 15%, 5%, 6%, but there's a major difference between the average and the actual. And let me give you a quick example. I'm not going to take more than a minute on this. Let's say that we have a $100,000 investment. I happen to be the best investment advisor you've ever met, so you invest money with me. At the end of the year, I got you 100% rate of return, so now your investment is worth $200,000. Now, the following year, I'm actually your worst investment advisor, and I lose you 50%. So if in the first year you gave me 100 and it went to 200,000, and the second year I lost you 50%, then obviously you go back to the original 100,000. Now, the mutual fund companies and the stock portfolio money managers will report that the average return on the portfolio is 25%. It went up by 100 in the first year. It went down by 50 in the second year. You have 50 left. You divide 50 into the 2 years, and it gives you a 25% rate of return. And they're not lying. They're telling you the truth. But again, there's a difference between the average rate of return and the actual rate of return. So although the mutual fund company is reporting a 25% return on your portfolio over a 2-year period, your actual rate of return was 0. You didn't make any money. As a matter of fact, you probably had a negative return, because when you invested the money with me, obviously I'm not going to do it for free, so I'm going to have to charge you a fee for that service in the year where I made money for you and in the year where I lost money for you. So it's something that is very critical to understand. Now, let's finalize with a case study. And let's talk about what we do with our clients whenever we engage them from a business standpoint. Now, I have changed the names in this particular client to protect the innocent, but this is what we do every single day whenever we engage someone from a financial perspective. And the first thing that we do at the bottom left-hand corner, we do all the provisional income calculation. We try to max out all their Roth IRAs and their 401ks. We also want to make certain that we're able to maximize and we can create for them a PERP plan, a personal insurance and retirement plan, that will mitigate many of their issues in retirement, including long-term care services. We also want to shift some of their investment to alternative investments away from the stock market volatility and interest rate volatility. And then we also go into real estate acquisition programs that create certain tax benefits for our clients that they don't receive in traditional market investments. So again, when we look at provisional income calculations, obviously we have to do a balance between our qualified assets and non-qualified assets. When we get into retirement distribution planning, our goal is to create higher income straddles and tax-preferred income. So not only are we able to get you to maximize your income, but we also are able to minimize your tax liability, so your income, your tax-free income goes up dramatically. And then right below that, we do asset and long-term care protection, because that's very, very critical. That is the icing on the entire cake, where we're actually going to do asset protection on one side of the ledger, and we're also going to be able to protect the spousal assets on the other side as well. So we want to make certain that whatever may happen, whatever life throws at you, because life happens every single day, that you are fully protected from an income and retirement perspective. Now, the case study is about a husband and wife, age 50. I get many of these on a regular basis. But this is a particular client that came to see me about a year ago, husband and wife, age 50. They have combined IRA amounts of about $600,000 combined between the two of them. They have traditional mutual funds of about $200,000. The husband contributes 10% to a 401k, and there's no match on that 401k, and that's a traditional 401k. The spouse works, but she doesn't have a 401k at work, so she contributes $6,500 to a traditional IRA every year. They pay $6,000 annually for 2 long-term care policies that they both have to protect each other in case of a long-term care need. And they also pay approximately $3,000 annually to fund term life insurance policies to protect themselves, again, from a premature death. And obviously, as 50-year-olds, they're maximizing on their standard deductions, mortgage deductions, qualified plan contributions, and they still have a couple of teenagers at home which are attending school, so they're taking some deductions on those as well. Now, what are the issues that we normally address with a client like this? And I did in this particular case. Number one, what will those IRAs be worth 15 years from now because the clients want to retire at age 65? And if I run them at 6 and 8%, where will that number be? Well, at 6%, those IRAs are going to be worth around $1,437,000. At 8%, they're going to be worth just north of $1.9 million. Now, that's going to create a problem, because when you get to age 70 and a half and you have to start taking minimum distributions, the IRS is going to require a large sum of money to come out of that portfolio. more than likely in excess of $95,000 a year, and all of a sudden there goes our provisional income calculation. So now 85% of all Social Security benefits and all its inflation rate will be taxed as well. So qualified plans actually create negative taxation on other areas of your portfolio as well. So we have to be very careful how we fund it and how we manage it from a business standpoint. Now, do we have the ability to do Roth conversion suitability? And do we have the ability to take a portion of those IRAs and start paying the tax today and then shift that net amount to the tax-free vehicle, either to fund a Roth IRA or to fund a Roth 401k along those lines as well? How about the emergency fund and opportunity? Again, you know, what is going to be the growth of those assets over the next 15 years? And do we have ways of keeping those at no more than 6 months of expenses, you know, for either emergencies or opportunities from that perspective? And we do all those net present value calculations for our clients along those lines. And then the 401k contributions. Obviously, we're going to move the entire contribution to a Roth 401k as opposed to a Roth IRA, because they have way too much money already in qualified plans, and they're only 50 years of age, and they're going to be working for an additional 15 years. So the other thing we're going to do is we're going to try through a proper PERP calculation is to find ways to recapture the long-term care and the term life insurance cost and to put that into the tax-free bucket as well. And then we're going to do all the provisional income calculations. And when we did all of these calculations with this particular client, what we were able to transfer from their traditional IRAs and their traditional 401k and shifting the traditional 401k contribution to the Roth 401k, in this particular scenario, we were able to identify $57,000 of income that the client was going to be reporting, and that we were going to be shifting to a tax-free bucket. Now, when you start to do that shifting, you have to pay taxes on that money today. So in this scenario, we had a net of $39,900 after paying taxes today, because it makes all the sense in the world, because taxes are going to be much greater for these clients in the future, and we're able to enjoy that benefit today. And if President Trump is able to reduce taxes even further now, then it opens a tremendous window of opportunity, but only for a very short 10-year period of time. So we shifted $39,900, and we divided that portfolio in the following way. We went ahead and funded the Roth IRA with $6,500. We funded the Roth 401k with $12,500. We made additional contributions to the PERP for $20,900. We also did the calculations on the future standard deductions. So by age 65, because of the fact that the standard deductions can go up by inflation every year, we project that those standard deductions for the clients today are going to be worth approximately $30,000 a year in the future. And then obviously we did the Social Security calculation, and then we did the net present value calculations for those clients out of the 401k. So we would create a complete retirement distribution planning that would enhance distribution levels and also would enhance and diminish tax liability. And here's the planning outcomes. When these clients retired, they retired at age 65, all the income that they're going to be generating every year and taking in distribution from the Roth 4 IRAs will pay zero in tax distribution. The income that they will take out of their personal insurance and retirement program will also pay zero in taxes. So zero is a new hero for our clients in retirement. The IRA distributions, they're going to pay zero in taxes. Not that the IRA distribution is not going to be taxed, but it is going to be offset with the standard deduction calculations. So we're just going to take enough out of the IRAs in order to offset it with the standard deduction and therefore not create a taxable liability from a business standpoint. Social Security distributions for both husband and wife will pay 0% in income taxes. So at the end of the day, we're going to have a portfolio where the Roth is going to be 0 in tax, the PERP 0 in tax, the IRA 0 in tax, and Social Security 0 in tax. What does that do altogether on behalf of the clients? Well, if the clients don't do any business with us and don't change anything that they're currently doing and they continue to contribute to their qualified plans of where they're doing it, if they stay the current course and taxes stay the same, they're going to be generating about $3.9 million of income in a period of 20 years after retirement. The challenge is that income is going to last to age 87. At age 87, if they're still alive, they're going to run out of income. If one of them is alive, it's going to run out of income. And that's in the best case scenario. Taxes will stay the same and they continue to do everything and they don't get sick and they don't have any volatility in their investments whatsoever. If clients stay the current course and taxes were to double, which is what we have all forecasted because of all the liabilities that we're going to have to deal with in the very near future. And remember, David Walker said that taxes are going to have to double or we're going to go bankrupt. Then if that's the case, the income is going to drop for them from 3.9 million to 820,000 for 20 years. And they're going to run out of income in 6 years earlier or 6 years sooner at age 81. But if they're smart and they do all the business and calculations that we set forth in this presentation for all of you, and they choose our planning straddles, and they choose our income straddles as well, regardless of taxes, whether they go down, they stay the same, or they go up, these clients are going to generate $5.2 million in income in 20 years, and that income is going to last for the rest of their lives. That is a big, big difference compared to whatever they could have done in the very near future. At retirement, because of the fact that we did a tremendous job in creating tax-free income distributions, the clients are going to be able to qualify for Medicaid and food stamps if they want to. That is what we truly call an economic planning at its best. And we're very proud of what we do in that endeavor on behalf of all our clients as we move forward in the 21st century. Next steps for all of you in this call, those of you that are clients obviously are already doing this with us, is schedule a complimentary private consultation with us. We don't charge any fees for any other services that we do as far as giving you private consultation. Determine your program qualifications. You may be able to qualify if you do qualify or if you don't qualify, but if you do qualify, to what level, to what extent, what impact is that going to have on your life? What would be the optimum tax-free income that we can generate for each and every one of you in this call? Determine the strategic retirement drawer straddle that we can place you in. You know, how do we balance those drawers and those buckets of contributions and distributions? Determine future tax-free income that you will be able to generate on a tax-preferred basis. We're going to complete an audit of all of your existing assets and investments to make certain that you are reducing that transferred wealth and the amount of money that you're spending. And we're going to do a complete audit of your insurance program to include your property and casualty, your insurance policies, everything from a business standpoint. And we're going to be able to create a tremendous capital management system that we call CCMS for Cambridge Capital Management System. So a couple of thoughts before we finish. Please bear in mind that we assist our clients primarily in changing the way they see things. Because at the end of the day, when they change the way they see things, the things they see change. So the minute you start looking at your life through a paradigm shift and through a telescope and making those changes, everything that you were seeing before from a different perspective is now going to change, and it's going to be a win-win not only for you, but for your family and for your beneficiaries for many years to come. Thank you all. I know we have spent very good quality time, and I appreciate the fact that you have stayed with me through this participation. Actually, most of you have stayed in the call, and we want to thank you. If you have any questions, feel free to email me at Bert, B-E-R-T, .Salazar, S-A-L-A-Z-A-R, at CambridgeFPLLC.com. That's Cambridge, CambridgeFPLLC.com. Thank you and have a wonderful evening.